let's see if all this software is working tonight. You don't have any mess-ups. Well, let's see. Can you hear me okay now, Sandy? Testing it, and I turned it on, and I would do it a few minutes early rather than have everyone sit there for 10 minutes while I fiddle around with something and then still can't get it to work. Hello, let's see. Okay, let's see. All right, well, I'm getting some green lines there, so apparently it's working. Bottom. Must be working. Okay. Oops, okay. All right, let's see here. Oh, that's bad. Oh, you gotta be kidding me. You've got to be kidding me. Okay, let's see if I can get this squared away. This isn't quite what I wanted. Huh. Crazy, crazy. Okay, let's see if we can close this up. See why this isn't working. Oop. Sandy.
Yeah.
Oop, I can hear you.
Yeah. That's because I got my mic on.
Wow. Okay, let me turn mine down, my ears down just a little bit, I think. All right. That's better, I think. Huh. Well, this is certainly a Beautiful.
Well, close the program and reopen it.
Yeah.
Probably just a glitch in the program. That looks fine to me.
Does it?
Well, now it's all pink.
Yeah, yeah. I got the first page just fine. It's the option prices that didn't come through so good. Huh. Well, I have no idea what the heck happened here.
It might be at their end, because that pulls from someplace else.
Yeah. Well, let's see if that'll do it now.
Yeah, that's pretty. I like blue.
Yeah, it's pretty. Yeah. Well, well, at least
Numbers changing up there.
the what?
There's a bunch of numbers changing up there in that little window. Whoop, the little window went away.
Yeah, that's just the update. Let's see if that helped. No, it did not. Okay. Well, we'll try it again. Process complete. Well, we're going to have to do it manually, I guess. It's probably a good idea anyways, because a lot of people don't have option view. And even those of us that do have option view or have access to option view, it doesn't always work properly. So, what can you do?
You just make up your own graph. Make up your own.
Yeah, I'll just make that bad boy up. Yeah. Okay.
In Excel or something.
Yeah, yeah. Boom, 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 boom.
How do you do it manually?
Well, I'll just have to do it in another program.
Oh.
Just have to do it a little differently. Yeah, it's too bad.
Looks like it's not pulling any data.
Let's see if it's. It's got the stuff for the E-mini. Ooh. No, it doesn't have them. Huh.
They're not pulling any data that they're in.
Yeah, not all of it, that's for sure. They're a little slim on the. Huh.
Well, maybe everything closed down today.
Why would it close today? Was today a holiday?
No, but you never know. Maybe, see, yesterday Thailand went into martial law. Maybe Europe did this year. I mean, did today.
No, they're not going to. They don't do that till the summer. Europe. Let me find Google. Okay, there's Google. Let's see if. Okay, well, they got Google. They got Google. Well, you know what? I may have to do this and just use a different asset just to show people how it works. What I wanted to show them tonight was just a variety of spreads that they can use.
For gold?
For gold, yeah, because gold is in a. Let me see if gold is even. See if it's even chartable. Yeah, it's got a chart. Okay. Well, with option quotes, this is kind of not going to work so good. Golly. 2 nights in a row with screwed up software.
Yeah. Thank God for computers.
Yeah, where would we be without these little gadgets?
In the backyard, sipping iced tea or lemonade and enjoying the scenery.
Yeah. Yeah, I guess. Oh, man. Yeah, well. Yeah, golly, I wanted to get started pretty quick because no one's home, and my little chihuahua is going to be going crazy as soon as people walk in the door. In fact, I better go close the door, so hang on a second. Well, Bernie's off to a Bible study, and Amy's off to, they're doing some special deal with BMW. They got the people from corporate in there.
Oh, good.
Oh, yeah. Yeah, people come and test drive their cars get $1,000 to a $1,000 coupon to use for the next 2 months, anytime during the next 2 months, to buy or lease a car.
Oh, that's good.
Pretty impressive bribe.
Won't work on me.
Yeah. Well, you got to go in and test drive the car, and
Oh.
I think they're probably closed now, so you probably missed that chance there. Sorry.
I'm not.
Oh, come on. You know you are.
I'm not. I want the Corvette.
Oh, God. You can drive Louis' Corvette.
Z06 with the 07 package in it.
Yeah, did you see, you know Louis
Which one?
out at the range?
Oh, no.
He's got one of those things. I don't know, 500-600 horsepower, 700 horsepower, or something like that.
The new Z06, the 2015, starts off at 625 horsepower, and the torque is 645 torque per inch. And they will fly.
It sounds like Louis. He gets a new one every year. One of those private label ones or whatever they are. You have to special order. You order like a year in advance or 6 months in advance or something like that. And I don't know, they're 80 or 100 or 120 grand. They're a lot of money just to get a ticket.
Oh yeah.
Of course, most of the officers want to continue to shoot at his range, so they don't give him too many tickets, I don't think. Or he could start charging them, because he doesn't charge them to go to the range. If he started charging them, then he could afford all the tickets he wanted, I guess.
Mm-hmm. Well, at least he can beat them all up to the range.
Yeah. Okay, well, we're going to have to do something a little different.
Does bar chart have that stuff?
And they have some of this stuff. Yeah, there's another problem that I noticed on the new version of the website that I need to tell Marlo about. Where are the options? They didn't include the options. So, oh well. They'll get it worked out. Take a step at a time, I guess.
Yeah.
But see, they're still a couple weeks behind. This is a chart for Wednesday, April 30th. So I wouldn't trust this stuff for what we need to do. So let's go back to the mothership. See if it'll work. Nah. What a mess. Metals, gold. What is gold? There was gold. Boom, 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 boom. Man, it was a hot one today.
Yeah, it was really nice. Like summertime.
Yeah, it was great. Yeek. Let's see here. Yeah, I'm surprised that what they have out here is different than what we have for our new charts. This stuff is much better than what and well, I guess they just need to add the other stuff, and then it'll be sweet. But you can kind of see what some of the stuff that we don't have. First of all, this always comes up as a bar chart instead of an area chart, which is just absolutely stupid. I don't know who the moron is that thought that one up, but they should go back to shining shoes. And then you can't tell if it's a daily contract or what it is. Now this you can daily, and for the time period 6 months and so on. So this is the way the chart should be. So they'd be easy to manipulate. Anyways, okay, so let's get started. It's 7:05, and today there's a webinar for myoptionsnet.com, and today we're going to be talking a little bit about gold. Gold, as we can see, is in a little bit of a channel. It's actually showing a bit Well, if you were to look at it like from this perspective, it's showing there's if you can imagine a trend line coming down here, uh, it coming down like this, and another trend line coming from this low going up here, and you can see that these are going to be intersecting. They look like they're going to be intersecting right about in here someplace. So in the next day or two, I anticipate that we'll start seeing a bit of a breakout in the gold, and whether it's the upside or the downside, it's very hard to tell. Now, there's a couple different strategies a person could use in this kind of an environment. And if you wait until the market makes its break up or down, you're too late. So the idea is that you get in, and you can see that the market has been going pretty much in a sideways channel. Let's see, right here, that was the high of 1307 and a low of, let's see, what was a low there? 1289, so 1307 to 1289, about a 28 point, I mean 18 point, about an 18 point range. And so, in fact, let's add the ATR here, and which is the average true range. We'll do that for 10 days. We'll adjust this for 10 days here. And let's see, where is the ATR? Okay, here's the average true range. Okay, 14.5, $14.40 is the average true range. But as we can see, that the market is starting to form a bit of a flag. And when you have a flag, to me, this looks like the market is going to be going down. It doesn't look like it's going to be breaking out. It's had a few attempts in here, 3 different attempts to break up, and it hasn't. On that day, which was the 15th, you can see right up here, you'll have the day of wherever the cursor is. But on that particular day, it was a higher high than the next day. Then the next higher day in here was still lower than the previous 2 highs. So you can see that it has tried that 3 times, couldn't break over that high. That's an indication of weakness, in my opinion. And you're seeing the lows are getting lower. The highs are getting lower, the lows are getting lower, and you're getting to where the market is, looks like it's going to be intersecting. So from this trend line going down and this trend line going up, it looks like they're going to be intersecting right around in here. And when they do, it looks to me like the market is going to be going down. So if I were to estimate where this intersection of these 2 trend lines is going to be, I would say it's probably going to be around the 1295 area, right about where it is right now, maybe slightly higher, but I don't think it's going to be much higher. So what is one of the strategies we could do? Well, one of the things we could do is we could get out in front of it and buy a 1295 put. And so let's take a look at the options and see what the options are going to cost us. This should put up a whole option chain here. And it does. Let's see. Now this is, the options expire May 27th. That's coming up awfully quick. That's a week from today. So I don't know if I'd want to stick with that, but if we're just looking for a quick pop, that might work. Okay, so 1295. Look at the 1295 put here, and that's at it's settled at $8.40. That's $840 for an at-the-money put. That is expensive. 1295. Let me go back to 1295. So now how far down? Okay, the 1295 put $8.40. That's $840. Okay, so now what do we think that let's go back to our chart here. Okay. How far down do we think it's going to go? Okay, it looks like there's some support here at 1280. And so let's see what a 1295 to a 1290 put is going to cost us. This is what's called a debit spread. It's a directional spread. Our risk is going to be defined by whatever this costs us. So it's $840, and the 1290 is at $620. So it costs us $220 to put that trade on. Now our maximum profit on that particular trade is going to be $500 less the $220 that we pay to put that spread on. It is a relatively risky trade in that it has to go in one direction. It has to go there in just 7 days. And if it goes down there, then we get to pick up all of our money. If it goes down to 1293, 1294, and if it were to go there and the options expire a week from now, at that point, we would just about break even. So if it goes up, well, we're going to have a loser of a couple $100. But that's the business that we're in, right? It's we're in a business of trading, and there's risk involved in trading, and we have to figure out what we think. In my opinion, this looks like it's going to be going down some. The market is looking weaker and weaker and weaker. We're having lower highs and lower lows. The trend is going to be intersecting in a pennant sort of a pattern, and when it breaks below that pennant, which I think it will, then I think we're going to see this thing break, and we may see this thing break maybe $8 or $10, maybe $12, down to the 1280s, the low 1280s, somewhere in there. So with that in mind, let's see see if this devil is updated yet. See if we can doggone it. I'm going to close this program out and see if it'll update when we bring it back up. Okay, so that's a particular trade, and that's one way of doing it. The other thing we could do is we look at like the 12. Let's see, what is the 1260, 1270, 1275 put, 1280 put. Now this, you would, you know what? I shouldn't even mention this because this is a pretty risky trade. But for those of you who are daredevils out there, this is one thing you could do. You could sell the options. This is what's called either you could call it a neutral option spread or a non-directional spread or something along those lines. You sell the 1275 put, sell it for 210, and sell the 1315 call, and now you're outside the range. Go back to the chart here. The 1315, you're going to be up here, and on the 1275, you're going to be down here. So you're going to be below support, and you're going to be above resistance. And so it is a possibility you could trade that, and you pick up 210 on one side, 210 on the other side. That's $420 less whatever the cost is. Now, as long as the options, as long as gold, a week from now, as long as those options expire with gold being somewhere in between those two, you get to keep the full $420 less the cost of putting the trade on. If it goes below it, the downside to a trade like this is you've got unlimited risk. You've got limited profit potential, but limited risk. Now you think, well, why in the world would anyone in their right mind do this type of trade? Well, if OptionView was working properly for us, we could show you that based on historical probabilities, the likelihood of the market getting to go below support or above resistance with only 5 trading days left is relatively remote. That doesn't mean it can't happen, but it's the likelihood of that happening is fairly remote. Of course, tomorrow gold could drop $40, and we have a $3,000 loser. But one of the ways you can protect yourself from that is you can sell the 1275 put, and then you can buy the 1265 put. It limits you some, and you can do the same on the upside. You can sell the 1275. I'm sorry, the 1315 call for 210, and then buy the 1325 call for 110. So if you're working where your commissions are $5, $6, $7, $8, you're in pretty good shape. You could do that, and now the market can't move in both directions at the same time. Now the downside is you still have $1,000 at risk, and your maximum potential profit is only a couple $100. So is it a great trade? Probably not, but it is a way to trade gold. And here's one more strategy that I'll give you. And one of the reasons why gold and most commodities are not very attractive for this type of trading at this particular moment is because volatility is very low in a lot of these markets. When volatility is low, if you're doing any option writing or whatever, and when options are very close to expiration, as they are right now, you can see that that you have to get very, very close to the market. The market's at 1285. We got to get almost on top of it to have an opportunity to make any money, and so it makes it a little more difficult. One more strategy a person could do is at the 12. Let's see, where is it at now? 1295. I think I just said 1285. I meant 1295, but when I said 1285, it kind of was rattling around. That's not right. That's not right. Okay, so what's another way of doing it? Okay, here's another way of doing it. Just selling the 1265 put, which is 30 points away from the market, and then selling the like the 1325 call. Your risk is still unlimited, but the market has to get over 1325, or it has to get under 1265 for you to get hurt. Now that's also a neutral option spread. That's selling out of the money options, and some people just don't like doing that. But some people, and a lot of people, make a fortune selling naked options. It is definitely a game for adults. It's not for the weak of heart or the whiners or the complainers. That's definitely not. This'll put some hair on your knuckles. It'll also make your put arthritis in your knuckles, I think, because you'll be holding on to that mouse so tight the first few times you do it. But the problem with doing something like that right now, like I mentioned earlier, is that the volatility is low, and so you have to get so close. And because we have very little time, you got a week left, and so I don't think that that is necessarily a great strategy in this kind of an environment. I would prefer to do something where it's our risk is defined and our profit potential is limited, but our risk is defined. We're not going to give up $1,500, $2,000 on a whack or anything like that. The most we're going to give up is $200 or $300. Now here's another strategy you could do. You could buy the 1295 put for $840, and then you could sell the 1285 put. So that would cost you roughly $400 to put that spread on. And our maximum profit potential on that particular spread is $1,000 less the cost of putting the trade on, which we already know is going to be $400 plus whatever your commission rates are. So you've got about a 2.5 to 1 reward to risk ratio, or your risk to reward ratio. So it's not terribly out of whack. It's not a terribly bad trade. The another trade that a person can do, if a person has a mind to, is what's called a straddle. Now, what we showed you earlier was a strangle, where we're selling the 1285 put and the 1315 call. That's what's called a strangle, and this is what's called a straddle. A straddle is where we sell in the same month on the same asset. We're going to be either selling or buying options at the same strike price. Okay, so we sell the 1295 call at roughly $8. We sell the 1295 put at roughly $8.40. So we pick up $16.40. Now, let's see. So that'd be a 1310. Okay, a 1310 call is $2.90. Okay, so now we've got, well, let's just say $3. So we've got now $13 of potential profit in this thing, and then on the bottom side, we could sell the 1280 put for we buy that for $3.10, and so that's another $3. So now we've got $10 of potential profit in this. So as long as the market doesn't go over 1305 or under 1285, we're going to be making money, and our risk is defined. Now that is a nice little strategy, actually. The market's not giving us much right now, but that's a pretty good, a pretty nice little strategy. So let's see. Does anyone have any questions so far about this? Let me put my eyes on so I can see if there's.
No questions.
Okay. All right. Okay. Well, very good. Well, yeah, that's unfortunately, OptionView is not cooperating with us this evening, and maybe I should have updated it before the markets closed. So maybe it might be my fault for because of an asset that is fairly thinly traded, because the bonds came up, Google came up, the E-mini came up, so other assets came up. I don't know why gold didn't, but in any case, those are a couple different ways where you can trade gold, and you can trade in markets, and you can take advantage of these last 7 days where time decay is really working on your side. And if you're an option seller, you really like time decay. So we show you some examples there of some strangles, and also an example of a straddle just now, where you could still get away with $10 of potential profit, and $10 from 1295, so it has to go down to below 1285 or above 1305 for you to start losing any money, and your risk is defined because the most you can lose is well, the market can't go both ways, so your maximum loss either way is only about $500. But if it stays right in here, and it stays in here for the next week in this little range, you could make some pretty good money. Now, keep in mind the average true range on a daily basis was $14.40. However, that is created, that true range, that average true range, is expanded because there's been a couple days where we've had some pretty big ranges in there, but I suspect that the ranges are that this market is running out of energy for the moment, and we'll see a few more days. And even if you didn't stay in it all the way to the very, very end, if you were to do a strangle or a straddle or any situation that was going to be, especially if there was a debit or a credit spread. Credit spread is where you collect money when you put the spread on. A debit spread is where you actually your pocketbook is being debited or your account is being debited. You're paying to put that trade on. Now, in most cases, not in every single case, but in most cases, almost every case, a debit spread limits your risk. In most cases, a credit spread is going to provide you the opportunity for unlimited risk. So you need to be very much aware of what your goals are, and you want to stay, in my opinion, you want to stay at least one or two standard deviations away from where the market is. And if you're not familiar with the term standard deviations, we can go over that. Email me this week and let me know if that's a term that you're not familiar with, and we'll go over all of it. And I'll next week I'll make sure that, well, this afternoon, Sandy and I got online about 15 minutes, 18 minutes early to make sure that there weren't getting any hiccups like we had last night. And so boy, we got everything was working, and I was really excited about that. I thought, wow, yippee, this is going to be great. And then lo and behold, OptionView did an update for me, and so we didn't have the ability to actually show you graphically what these different spreads would do. So next week, if that's of interest to you to understand standard deviations, and in the OptionView model, you'll see it clearly by a variety of colors that will tell you where you need to be at least one or two standard deviations away from if you're writing options. So anyways, it's never a good idea to be less than one standard deviation away from where the market is at a particular moment. I don't care if you've only got, a very, very short period of time. You need to give yourself that distance. Time and distance can be your friend or your enemy in options trading. But we need to learn to use our allies appropriately and avoid the things that undermine a variety of strategies. If you're buying options, then time decay works against you. If you're selling options, then time decay is your friend. If you're selling options, you really want to sell options with when the volatility, the implied volatility, is relatively high, and the statistical or historical volatility is in a normal trading range, yet it's still well below the implied volatility. So otherwise, just a small spike in the historical volatility can cause a really big spike in the implied volatility. And if you were selling options, now it can get those options that you sold can go up in value very quickly, and it's kind of like hanging. It doesn't go up geometrically. It can go up exponentially. So in value. So it can work against you very, 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 very quickly. So anyways, I guess that's pretty much it for me for tonight. Does anyone have any questions or anything before we sign off? I apologize. We've had 2 nights in a row with these technical boondoggles. I guess I've got to start more than 15 minutes early to make sure we get everything squared away. And I'll keep the defibrillator ready for Sandy, and Sandy can keep the defibrillator ready for me. So we're ready to go, and we get the programs ready to go, and we'll be all set. So also, if you haven't taken a look at, well, you haven't had an opportunity to take a look at it the new version of FreeCharts yet, but it should be coming out. We sent it back to the development team, and we should have, hopefully by tomorrow, we'll have it back, and it should have a lot of the fixes that we wanted in it, and a lot of the other things, excuse me, are going to be minor fixes, but these are some of the more important fixes that have to be set up. And then once that's done, Sandy will take that site and publish it, and then you'll see what the new one is going to look like. And it is beautiful. It's great. It loads quick. It's really nice and clean and crisp and that kind of thing. It'll take you probably 15 or 20 minutes of playing around with it to get used to the way it operates and that kind of thing. But virtually all the features that we had on the old FreeCharts is going to be on the new FreeCharts, and then and it's modular, so we can add additional things to it going forward. And so we're really excited about that. And these guys have worked with us for years. They've done a great job with us. It's a company by the name of Barchart. They're the ones we use for our data feed, and we've used them for our data feed for 17 or 18 years. And I think it was from 1997, 1998, somewhere in there. It's been quite some time. Anyways, because we've been with them so long and consistently, I mean, we've been with them every month for these 16, 17, 18 years, whatever it's been, that they take really good care of us, and so we really appreciate them. And so, anyways, let's see. Any questions? Anything that I can help you with?
No questions.
All righty. All right, very good. Well, again, thank you for coming out tonight. I appreciate your time, and hope you'll read the newsletter on Friday, and then we'll be ready to go on Monday again. Thanks. Good night.